What is this 7-year rule all about? Let's find out today. Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. As we all get older, the 7-year rule becomes quite an important rule that many of us will become aware of. And the reason we'll become aware of it is because it's a way of reducing your inheritance tax by gifting away different things to family members. So if you sell a property, for example, and you get a cash lump sum from that sale, you've now maybe got 100, 200,000 to do something with, which you may not need it to do anything with. So you think, well, actually what I'm going to do is gift it to some of my family members, maybe children, grandchildren. So let's work on a scenario today that I've got 2 children and we're going to give each of those 100,000 each. So what happens? Now, on the basis it's not just out of my normal income, it is going to be falling within the realms of it's part of my estate, and I'm now gifting to those children what's known as a potentially exempt transfer, shortened to a PET, as you may hear as you understand this area of things. Now, as soon as I give this gift, the 7-year rule kicks in. So what is the 7-year rule? Well, it basically means if the person who gifted that money to, in this scenario, their children, if they live for another 7 years, then potentially there's no inheritance tax on that transfer of 100,000 to each of them. So this is why we have the PET, which is potentially, because if something happened to the person who gave the money within 7 years, then it would fall within the realms of their estate, which means I've now got tax to pay on that amount. But if they live for more than 7 years, there's no tax. It's just a gift and you've, in essence, got it tax-free. So this is really great that if you can use this 7-year process regularly, so maybe every 8 years you give another amount of money to whoever you want to be gifting money to, and in essence by the end of your life you've gifted as much of your money away as possible. So it's a great way of reducing the value of your estate at any point in your life. Now obviously, if I've gifted something today and something happens to me in that 7-year period, they're not just going to suddenly say, okay, let's pay all the tax or pay no tax. There is a staggered approach to how they will then tax that gift. So let's just go into what happens if something happens to the person who gifts that money within the 7-year period. Now, unfortunately, if something happens to the person who gave that gift within the first 3 years after they've given that gift, the full inheritance tax kicks in. So that money that has been gifted will fall within the estate that then calculates how much inheritance tax is due. So for 100,000 or 200,000, there'd be 40% tax on that. So there'd be 80,000 that would disappear from that. Now, after the 3 years, and where we go from 3 to 7 years, there is a sliding scale of how much tax actually becomes due. So let's go into that in a second. Before we go into that, we probably just ought to mention that if the estate is not worth more than 325,000 in total, then arguably it doesn't really matter when you give that gift because there's not going to be any inheritance tax. If, however, you have more than 325,000, it is very key to be aware of these rules because then you can hopefully minimise any inheritance tax that may be due on that person's demise. For any gift that you've been gifted more than 3 years ago but not quite 4 years, that falls into the tax rate of 32%. So as you can see, it's less than 40%, but it is still a reasonable proportion of inheritance tax that would become liable. As we move into years 4 to 5, this reduces down to 24%. So as you can see, it's now starting to really come down. If the gift was given more than 5 years ago, but not quite 6 years ago, we're down at 16%. And for the final year, where we're between 6 and 7 years, we're down at 8%. So as you can see, it comes down quite noticeably over the period of 7 years. So even just giving a gift and not living the full 7 years, but living for over 6 years, that's really significantly reduced the inheritance tax liability at this point in time. So the 7-year rule is a really great way of minimising your inheritance tax, or minimising those in your family's inheritance tax if it's you doing the planning. Ideally, as you do gift different things to different people, it's great if you can make a summary to show what date things are gifted, how much is gifted, and then it makes it very easy for any executors to find what gifts have been given, if there's any tax that may be due, or hopefully if you've been doing the planning that it's definitely not due because the date that the gift was given is definitely over 7 years ago. Any executors on an estate will have a look through different things like bank accounts and any records that are there for the person who has passed away, to check what they can see. So if there are any large gifts and things like that, they will notice them and see whether there is any inheritance tax that might be due on those balances. So the more information that they have available, the easier it is hopefully for them to see that if it is over 7 years ago, it's not going to fall within the estate and you don't have to worry about any tax becoming liable on it. As we have mentioned, we all have a $325,000 allowance for inheritance tax that the taxman will allow us to do whatever we will with, and there will be no inheritance tax. If you have gifted more than that sort of amount in a 7-year period, anyone who has had any gifts within that 7 years that hasn't gone past to no longer be due for tax, they will potentially be liable for taxes if anything happened to you. So it's just a matter of managing the 7-year rule to see who is going to fall within that maybe 325,000. For example, if you have 4 children and you decided to give them all 100,000, then the last person to get the gift would suddenly find that 75,000 of their gift is actually taxable to them should anything happen in those 7 years. Whereas the other 3, potentially, they're within that 325,000. So you just need to manage how much you're gifting and that 7-year period to make sure that you're not inadvertently giving someone an inheritance tax bill that you didn't necessarily intend to give them. The 7-year rule is a great way of managing your inheritance tax, and if done early enough, then it gives you much scope to minimise any inheritance tax that might be liable by the family on someone's demise. So get planning, and hopefully you can minimise any inheritance tax that you or your family may be incurring. Hopefully you've got an understanding of how the 7-year rule works with any potentially exempt transfers you may have gifted or been received. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing.